Every way people lose money explained. Inflation. You receive a $5,000 raise at work and feel richer than ever. Then a year later, groceries cost more, rent goes up, insurance premiums increase, and even your morning coffee gets pricier. Suddenly, that raise doesn't feel nearly as impressive. That's inflation. A gradual increase in prices that quietly reduces what your money can buy. The surprising part is that your bank balance may never decrease, yet your purchasing power slowly does. Think of it like a melting ice cube. It still looks like ice for a while, but a little disappears every minute. Inflation works the same way, except it melts value instead of water. This is why many people invest instead of leaving all their savings in cash for decades. A dollar that sits still while prices keep moving eventually falls behind. One of the quietest ways people lose money isn't by spending it. It's by watching its buying power slowly fade away. Bad debt. A new phone today for just a few dollars a month sounds like an easy decision. The catch is that borrowed money almost always comes with a price attached. Bad debt usually refers to borrowing for things that lose value quickly while charging high interest, such as credit cards with unpaid balances or payday loans. At first, the monthly payment barely seems noticeable, but interest keeps growing in the background every single day. If you only pay the minimum amount, much of your payment goes toward interest instead of reducing the original debt. It's a bit like trying to empty a bathtub while someone keeps turning the faucet back on. Over time, a purchase that originally cost hundreds of dollars can end up costing much more. Debt itself isn't the villain. Many mortgages and business loans create long-term value. Expensive debt becomes dangerous because it quietly turns yesterday's spending into tomorrow's financial burden. Scams and fraud. The message looks professional, the website appears real, and the opportunity sounds almost perfect. That's exactly why scams work. Modern scammers rarely rely on obvious tricks. Instead, they build trust before asking for money or personal information. Some pretend to be banks, government agencies, delivery companies, or even family members in urgent situations. Others promise guaranteed investment returns or unbelievable prizes. Once money is sent or sensitive information is shared, recovering it can be extremely difficult. What makes this especially dangerous is that scammers target human emotions more than technology. They create urgency, excitement, fear, or sympathy, making people act before thinking. Even experienced professionals have fallen victim to sophisticated fraud schemes. The lesson isn't that only careless people get scammed, it's that anyone can be vulnerable when the right story meets the right moment. A few minutes of verification can sometimes prevent years of financial regret. Poor investments. A friend tells you about an investment that's guaranteed to double your money, and everywhere online people seem to be talking about it. By the time most people hear those stories, the biggest gains may already be over. Poor investments often begin with excitement instead of careful research. Many investors buy because everyone else is buying, assuming prices will continue climbing forever. But markets rarely move in a straight line. When enthusiasm fades, prices can fall just as quickly as they rose. That's when expectations collide with reality. Successful investing isn't about finding the hottest trend every week. It's about understanding what you're buying and accepting that every investment carries some level of risk. Even experienced investors make mistakes, but they usually avoid betting everything on one exciting opportunity. The biggest financial losses often don't come from bad luck. They come from making decisions based on emotion instead of information. Impulse spending. You've probably walked into a store for one thing and somehow walked out with 5. That's impulse spending, buying something simply because it feels good in the moment rather than because you plan to. A flashy sale, a limited time offer, or even a colorful display near the checkout can trigger an emotional purchase before logic has a chance to catch up. One small purchase rarely hurts your finances. The problem is repetition. A $10 snack here, a $25 online deal there, and a few forgotten subscriptions can quietly add up to hundreds or even thousands of dollars over a year. It's a bit like a tiny leak in a water bottle. One drop doesn't matter, but enough drops eventually leave it empty. The biggest threat isn't one expensive mistake. It's dozens of small decisions that seem harmless on their own, but slowly drain your money without you noticing. Taxes. Getting your first paycheck can be both exciting and surprising. You expect to receive the full amount you earned, but the number that actually reaches your bank account is often smaller. That's because taxes are collected before or after money reaches your hands, depending on the type of income. Income taxes, sales taxes, property taxes, and investment taxes all reduce the amount of money you ultimately keep. At first glance, it may feel like you're simply losing money. In reality, taxes help pay for things that most people use every day, including roads, schools, emergency services, and public infrastructure. The interesting part is that the tax bill isn't always fixed. Retirement accounts, tax deductions, and certain credits can legally reduce how much you owe. Paying taxes is unavoidable in most countries, but understanding how the system works can help you keep more of your earnings without breaking any rules. Unexpected emergencies. Life has a way of staying perfectly normal right up until it doesn't. One day your car breaks down, your roof starts leaking, or an unexpected medical bill arrives in the mail. Suddenly, thousands of dollars disappear from your budget without any warning. These expenses don't happen because someone made a bad financial decision. They're simply part of life. The real difference is how prepared you are when they arrive. People with an emergency fund can often pay the bill and move on. Those without savings may have to rely on credit cards or loans, turning one unexpected expense into years of debt. Think of an emergency fund like a financial airbag. You hope you never need it, but you're grateful it's there when something goes wrong. No one can predict exactly when emergencies will happen. Preparing for them isn't pessimistic. It's one of the smartest ways to protect your future finances. Depreciation. Drive a brand new car off the dealership lot, and it may already be worth less than you paid just minutes earlier. That's depreciation, the gradual loss of value that affects many things people own. Cars are one of the most familiar examples, but they're far from the only ones. Smartphones, laptops, furniture, appliances, and countless other products become less valuable as they age, wear out, or are replaced by newer models. Unlike a stock market crash, depreciation usually happens slowly, making it easy to overlook. The good news is that losing value isn't always losing money in the traditional sense. Many purchases are meant to be used, not sold for a profit. A family car provides transportation, a laptop helps you work. The key is understanding which purchases are likely to appreciate over time and which are expected to lose value from the moment you bring them home.